The dark side of AI-powered trading, risks and limitations. Are you ready to revolutionize the financial industry with AI-powered trading? Tune in to find out the promises and pitfalls of this technology. Welcome to our video about AI-powered trading. With the power of artificial intelligence, this technology has the potential to revolutionize the financial industry in ways we never thought possible. But before we jump into details, it's important to understand the risks associated with this technology, as well as data privacy ethics, moral implications, and regulations that should be in place when utilizing AI-driven models. Tune in now to learn more and get a better understanding of the promises and pitfalls that AI-powered trading has in store for the financial industry. Now that you have a better understanding of the potential of AI-powered trading, make sure to subscribe to our Life Hacks channel to stay up to date with the latest news, tips, and tricks in order to make the most out of this technology. Keep watching to learn more about the promises and pitfalls of AI-powered trading, and how you can stay ahead of the curve. AI-powered trading utilizes algorithms and machine learning to try and spot patterns in data, but it's still hard to predict what will happen within 100% certainty. This means investing with this kind of technology does come with a certain level of risk. Plus, AI models don't take into account any of the unexpected external factors like political events or natural disasters, which can have a big impact on the investment's outcome. On top of that, there isn't much information about how the systems are programmed, and using them makes some people wonder whether they're accurate and reliable as an investment tool. AI-powered trading may offer potential benefits, but it isn't a surefire thing. Machine learning algorithms can be used to make investment decisions, but they're based on past performance and assumptions, which don't always predict the future accurately. This means unexpected events or changes in the market can lead to inaccurate outputs from these algorithms. That's why it's important to have human intervention to monitor and adjust strategies as needed so investments don't suffer huge losses due to unforeseen factors. Despite the potential of the AI-driven models, they come with some hidden risks. Since it's not always clear how these systems have been programmed and implemented, appropriate regulations are needed to ensure the safeguards are in place before investing utilizing AI technology. AI-powered trading can lead to financial damage if used incorrectly. For example, a flash crash when the stock market suddenly drops off due to an automated program executing large orders quickly without human intervention. This can have serious consequences if it's not monitored. Bots are also used to manipulate markets on exchanges around the world, and it's hard to keep track of what they're doing. Not only does this hurt people financially, it also makes people lose trust in the markets. That's why it's important to have regulation in place when it comes to investing with AI. This way, there are measures in place to manage risk and protect people from losing money due to speculation or wrong decisions made by computers instead of humans. So what steps should governments take to regulate artificial intelligence? Share your thoughts in the comments below. What steps should they be taking? Tampering with AI-powered trading has the potential to be particularly dangerous. Once an algorithm is in place and making decisions, it's difficult for humans to know what kind of actions are being taken or how reliable the outputs could be. Manipulating the algorithms so they execute incorrect trades can lead to huge losses due to inaccurate predictions if not monitored correctly. This can cause investors substantial financial damage as a result of faulty decision-making from malicious actors trying to capitalize on this tampering. It's essential that steps are taken by governments worldwide and other relevant stakeholders to regulate artificially intelligent technologies for investing purposes, before more people get hurt financially. Without proper precautions, investors can suffer huge losses due to malicious actors tampering with AI-powered trading. So what measures can businesses take now to proactively prevent the risk of tampering when it comes to the use of AI-powered trading? Tampering with AI-powered trading can be a real threat to the financial well-being of investors. Any manipulation or hacking can lead to inaccurate predictions and potentially huge losses due to malicious actors trying to take advantage of the tampering. That's why it's important for businesses to use AI and AI-powered trading systems to have a proper security measure in place and monitoring protocol. That way, they can do their best to prevent external interference when utilizing artificial intelligence technologies like machine learning algorithms. When it comes to investing decisions, there are both pros and cons associated with emotional and computational approaches, yet many organizations tend to rely more heavily on one over the other. Without considering how an appropriate balance might benefit them financially, what role should emotion play alongside computational approaches like artificial intelligence technology for business owners who choose automated investments to be successful? For business owners who choose to use automated investments, striking the balance between emotional and computational approaches is key. Artificial intelligence technology can make fast calculations based on data input from humans or algorithms, but it may not always take unexpected external factors into account, which could have an adverse effect if left unchecked. On the other hand, emotional trading can give traders more freedom with their decisions, allowing them to be better prepared for unforeseen events that algorithmic-driven models might miss out on. When global markets are concerned, especially due to a disruption caused by political events or natural disasters, a combination of both approaches provides far greater protection than relying heavily on one side over another without considering what's best in each particular situation. This can include having dynamic adaptation capabilities combined with informed decision-making using AI technologies where applicable, to avoid financial losses later down the line due to faulty outcomes from unmonitored AI-powered algorithms manipulating global markets. As governments worldwide implement regulations aimed at protecting investors investors while investing using artificially intelligent systems, these measures should also include stringent safeguards against artificially created volatility caused by malicious actors tampering with investor funds, while keeping people safe during times of disruption and unrest across all sectors, including finance. This leads us to a question: how much control do we need to exercise over manipulative tactics within forms of algorithmically driven models, so they don't distort prices through market manipulation? Share your thoughts on how to protect investors from the malicious use of AI-driven models by leaving a comment below. AI-powered trading has the potential to be highly disruptive on a global level if used irresponsibly, leading to significant losses for investors. That's why it's essential that governments and other relevant authorities implement regulations and monitoring to keep AI in check. Transparency is also important so its use can be held accountable in case of any unethical or irresponsible actions taken by market players manipulating the prices with algorithms set up for their own benefit. Another thing to consider when discussing AI-driven models is the global landscape, which can affect how these systems are implemented and managed across multiple jurisdictions around the world, where laws vary significantly due to economic and political factors. These considerations require us to think about the larger moral implications of using this kind of advanced technology responsibly, while still obtaining the desired financial outcomes without tampering too much with existing markets that have built trust over time among participants, including traders, brokers, custodians, etc. As many voices come together to tackle the problem at hand and increase efficiency in the overall system, there needs to be some kind of agreement on a code of ethics before advances in machine learning and autonomous robots start driving investment decisions at different levels. Otherwise, we could find ourselves facing incomprehensible consequences that we're currently unable to understand or anticipate fully at the moment. Staying alert to possible scenarios is the best way for the future in the right manner and complying with everyone else's standards, which will ensure progress occurs naturally, ensuring the safety and security of our money and investments in the long term. Alongside that same air of caution and respect, this will provide a fertile ground for development of artificial intelligence in the corporate financial industry if done properly going forward. When using AI-powered trading, it's important to consider the global landscape, as political and economic events can have a big impact on market conditions. Plus, AI-powered trading has no moral implications. Algorithms can be biased or discriminatory if they're not monitored for potential flaws and ethical issues. Automating jobs can also lead to social divides, as unequal opportunities can be created for those who are affected by closed positions through automation models that don't have diversity controls. Therefore, it's important for all stakeholders involved in developing these solutions to consider existing applications before moving into uncharted territory. New mentalities such as responsible artificial intelligence or RAI must be taken into account when applying data-driven methods, whether it's used internally across a private ledger financial institution or investment managers outside regulatory authorities. Compliance requirements must also be met prior to the interval. AI-powered trading is a rapidly evolving field with many potential opportunities to improve the financial sector. New technologies like blockchain, natural language processing, and machine learning can be applied in various ways to not only increase the speed of transactions, but also make them more transparent throughout the life cycle. Humans are now facing challenges like high-frequency trading or complex investment strategies that are difficult to track manually, making it necessary to integrate analytics tools in traditional stock markets. This helps decision makers in real time and provides safety against vulnerabilities like extreme market movements and fraud. Tasks that were once thought impossible now seem feasible due to emerging artificial intelligence techniques. For society at large, these new advancements have brought questions about data privacy ethics the company must consider. When implementing knowledge into these systems, it's important to provide safeguards in place so investors' money doesn't suffer because of malfunctioning algorithms used by malicious actors to try and take advantage. When you choose cryptocurrency over stocks, there should always be an inherent human element overseeing all operations and multiple levels to ensure proper regulations during the process. In the next few years, following strict laws and close monitoring, governments will be able to develop the technical capabilities to make any environmental adjustments, smoothing out the rules out of various worldwide projects. Although speculation is a popular idea, the reality is that if done correctly, outages, crashes, and scandals will become minimal while improving services for everyone. Before anything happens, 2025 might break through the beyond expectations. AI-powered technology and trading can lead to financial damage if used incorrectly, as malicious actors can use algorithms to manipulate markets and cause investors to suffer huge losses. That's why it's important for governments to implement regulations to ensure that investors are protected while investing with AI technologies. Businesses can also take proactive steps to prevent external interference and tampering with investing in AI systems. Striking the balance between emotional and computational approaches is key to ensure that investors don't suffer financial losses due to faulty outcomes from unmonitored AI-powered systems manipulating global markets. In addition, businesses should consider data privacy ethics when implementing AI systems and ensure that proper safeguards are in place to protect investors' money. 2025 might bring advances in artificial intelligence technology that can improve the financial sector, but only if done correctly with proper regulations and close monitoring. Are you interested in learning how to build a profitable AI trading bot from scratch? Do you want to learn the necessary skills to get started in this exciting field? Don't miss out on this opportunity to learn the ins and outs of AI-powered trading. Watch the next video to get started.